Okay, I would like to thank everyone for joining us today and welcome you to our webinar, Estate Planning Opportunities Created by COVID-19. We'd specifically like to thank and welcome the Jewish Federation of Broward County and the Jewish Federation of South Palm Beach County and their members on this call. My name is Ed Smith, and I'm a principal in our Boca Raton office. I would like to take a brief moment to introduce my colleagues who will be speaking today. All of our speakers today are members of the firm's Private Wealth Services Group. In addition to myself, we have Marjorie Horwin, Managing Principal of our Boca Raton office, Michelle Ferrara, Principal in our Boca Raton office, and Gary Duboff, a Principal in our New York City office. The MBAF Private Wealth Services Group works with high net worth and ultra high net worth individuals, closely held business owners, and corporate executives for their family office needs and tax compliance and planning needs. So, what are we looking to accomplish today? We'll go on to the next slide. Well, we're going to look at some general estate planning information, where we are today, how we got here, and where we may be going. We're going to look at a summary of valuation discounts and methods of transferring assets. We're hopefully going to provide an understanding of some of the best techniques to use in this current environment, including sales to defective Grantor Trusts, Spousal Lifetime Access Trust, Grantor Retained Annuity Trusts, and Charitable Trust. Now, if you have any questions, please feel free to write them in the Q&A section during the program, and we'll try to answer as many questions as we can as we move forward. Currently, as we go into the next slide, the lifetime gift and estate tax exemption is at an all-time high of $11.58 million and $23.16 million for a married couple. The current exemption levels are going to sunset effective January 1st, 2026, and will revert to their pre-2018 exemption level of $5 million plus indexing. So basically, they're going to get cut in half. Assuming you'll be celebrating New Year's Day on January 1st, 2026, at the current estate tax rate, if you don't use the extra exemption available to you now, you basically will lose an estate tax savings of approximately $4.4 million per couple. Now, the annual exclusion rate remains at $15,000 for 2020 or $30,000 with gift splitting. But remember, every annual exclusion gift over $15,000 eats into your lifetime exemption. On the next slide, we're really going to talk about what is estate planning. Estate planning is based on an individual set of circumstances, their income needs, their goals, their risk tolerances, what assets they own, how those assets are structured. It's not a one-size-all-fits approach. Some issues to consider for you personally are, do you desire to maintain control of your asset or your business entity? Do you have a need for income, or do you make enough income and have excess securities or whatever that are available for planning? What are your family dynamics? Do you have children that have spendthrift issues or troubled marriages? You know, do you need to structure entities, or if you have entities currently, do you need restructuring those entities to make the best use of gifts? COVID-19, while interrupting all of our lives, may have provided a great opportunity to use the extra exemption amount. With depressed asset values due to current conditions and hopefully short-term future forecasts, discounts on top of that, lower stock market prices, it creates a great time to consider making some of these planning decisions. Lastly, don't forget, it's an election year. So depending on the outcome, tax laws could change very quickly. Not to mention, with all of the monies that have just been spent on corona relief efforts, there could be changes in tax rates coming sooner rather than later. The economy could recover with a boom in the next year, with the possibility of companies moving manufacturing back from China and other countries as we've learned supply line lessons from COVID. As a result, there may not be a better time to plan over the next 5 years, assuming we still have 5 years. You know, the best part, going into the next slide, the IRS issued final regulations saying if you do use your exemption, and it is ultimately lowered, there will be no clawback of the used exemption. The IRS also confirmed that the use by a surviving spouse of their deceased spousal unused exemption for a previously deceased spouse will also not result in a clawback. So if you have these available and you have the ability to use them, it is something to consider. Going on the next slide. A couple of weeks ago at an earlier seminar, our valuation group, who will be integral in a lot of these potential planning ideas, spoke to everyone about business valuations during this time and what goes into making them. So what we're going to talk more about, lack of marketability discounts and control discounts, but we're going to talk about them in relation to using them with planning vehicles to leverage or freeze values and get the best bang for that buck. Before we do, though, I wanted to talk briefly about interest rates, specifically AFR rates and the 75/20 rate. The AFR rates are a group of rates published monthly by the IRS for various tax purposes. They are the minimum rates that the IRS allows for private loans in considering them, say, legitimate and to avoid adverse income or gift tax consequences. Currently, the AFR rates, which are divided into three categories: short-term rates, which are under 3 years, mid-term rates between 3 and 9 years, and long-term rates for notes that are going to exceed 9 years. The short-term rate in May is 0.25%, the mid-term rate is 0.58%, and the long-term rate is 1.15%. Believe it or not, those rates are going to go down in June to 0.18 short-term, 0.43 for mid-term, and 1.01 for long-term rates. So if you currently have family loans, consider refinancing them or using these rates as an additional tool, like providing a family loan so your children or others can buy assets and repay you for them, because everything they make over that rate will go into their pocket tax-free. The 75/20 rate is a rate that's used to discount the value of annuities, life estates, and remainders to present value, and is also revised monthly. It's basically the IRS's presumed rate of return, the hurdle that you have to get over in order to make these things work and get the best bang for it. Lower rates favor the techniques we're going to discuss today. Calculations for these techniques take into account a number of different factors, including the term, the amount of the lifetime annuity paid out, as well as the interest rates themselves. But the lower rate increases the present value amount of the annuity interest and therefore reduces the value of the remainder. That's beneficial. Higher rates benefit other types of planning vehicles like qualified personal residence trusts or charitable remainder trusts. So when you're looking to transfer, going on to your next slide, we're going to be, again, talking about the various discounts, especially as it relates to businesses and other matters. But before we move on to discussing those items, let's take our first polling question. Are you considering your estate planning options as a result of the changes in the financial environment currently? Simple yes or no question, and we will have about 30 seconds for answers to compile. Okay, the majority are currently looking at potentially doing something, which is good. Next, we're going to have Marjorie Horwin, again, managing partner of the Boca Raton office, come on to discuss partnerships, LLCs, and sale issues. Marjorie?
Good morning and welcome all. I'll be covering family limited partnerships, and why utilizing this vehicle is even more advantageous during this current unprecedented environment. On the next slide, we'll see just what a partnership, family limited partnership is. And if using an FLP, or you can interchangeably refer to an LLC, limited liability company, they're both taxed as a partnership. So an FLP is simply a holding company that is owned by two or more family members or entities. Assets such as marketable securities, real estate, private business interests are transferred to the FLP in exchange for partnership interest. Typically, you're going to have both the general partnership interest, those are the managers of the partnership, and limited partnership interests. Those are the passive partners. Then over time, senior members typically gift or sell interest to family members, trusts for the benefit of family members, or anyone else they desire to receive the property. For gift tax purposes or setting a sales price for the interest, there is an inherent discount taken in valuing the partnership, as opposed to just looking at the underlying securities or assets. These discounts, which Ed was referring to, are applied to ownership interest to reflect that there's a lack of control and there's a lack of marketability. The discount for lack of control implies that the limited partners, they can't control the day-to-day business strategy and the amount of distributions paid. A discount for lack of marketability captures the disadvantage of owning a relatively illiquid investment. Senior members like the fact that they can retain some control over management of the partnership, but this is where you have to be very careful. There's been a good amount of case law that gifts or sale of a partnership interest can be brought back into the senior's gross estate if the transfer is not considered to be a bona fide sale for full and adequate consideration, and the senior is continuing to retain possession or enjoyment of the property transferred. To prevent this argument by the service, you need to establish the existence of a legitimate and significant non-tax reason for creation of the partnership. Also, you want to respect the partnership. The partnership should not be a personal pocketbook. Funds should not be commingled. This is very important, and clients need to work with their tax professionals in this area so the entity is respected. On the next screen, we'll talk about what are the benefits of an FLP. As Ed mentioned, we are in a historically low interest rate environment. The applicable federal rate long-term in May, 1.15%. It's extraordinary. So if you sold the partnership interest either outright or in trust for the family members, that means that much less would come back into senior's gross estate, and the funds can remain in the partnership to grow into outside of senior's gross estate. The second, also that gift tax exemption. It's so very high, and we don't know if there was a change in administration, if it will continue to be at that 11 million and change or 23 million and change for married couples. We want clients to take advantage of this exemption if they can afford to, if they have extra assets. Entity discount. If you're making a sale or gift, they're still available. There was a time back in 2016 when the IRS proposed regulations to curb valuation discounts, but this did not come to fruition, so we still have that ability to leverage. This is a difficult economic time, and an FLP serves as an asset protection vehicle because creditors can only get a charging order against the partnership and not the partnership interest. If a court grants a charging order to a creditor, the creditor cannot force the general partner to make a distribution. Moreover, the IRS requires the creditors to pay taxes on the profits of the partnership. So holding assets in an FLP is a very strong deterrent for a legal opponent because of incurring a tax obligation without the corresponding income. Also, with a limited partnership, we recommend that the general partners have their interest owned by an entity like an LLC because they don't have limited liability like that of the limited partners. There's also income tax benefits of a partnership. There's only one level of tax, and it's a pass-through entity. When you sell a partnership interest, all future appreciation passes to the family members and will not be growing in seniors' gross estate. So there's a real ease in succession planning because you have that partnership agreement which outlines the rules of the partnership. On the next slide, we're going to talk about a type of trust that works very effectively when gifting or selling a partnership interest, and that's an intentionally defective grantor trust or an IDGT. Using trusts are always a preferred vehicle when implementing estate planning because those assets are creditor protected and the grantor can put controls on the distributions of income and principal. When making transfers to an IDGT, the transfers are complete for gift tax purposes, but they're defective or incomplete for income tax purposes. Accordingly, the grantor continues to pay tax on the income of the partnership. That further reduces seniors' gross estate, and then the beneficiaries may receive distributions income tax-free. If a sale of a partnership interest is made, it is not recognized for income tax purposes, so you have no capital gain, nor is the interest on the installment note recognized for income tax purposes. If the grantor becomes tired of paying the income tax, there can always be provisions in the trust document that allow you to turn off the grantor status, and then the trust is responsible for reporting the income. I particularly like an IDGT very often over a vehicle like a GRAT that we'll be discussing. Gary will be discussing that later on in this call, but if senior dies during the term of a IDGT, the IDGT is not subject to estate tax. It's not included in the senior's gross estate. Also, you can use slightly lower interest rate instead of 120% of the federal midterm rate. So there's some advantage. There's a time and place for each type of vehicle. Now, on the next slide, let's talk about, do I recommend to a client a gift or an installment sale of a partnership interest to an IDGT? And you know, it all depends on whether the senior member wants to use their exemption or retain a note and have that asset in his gross estate, but they're pushing out the future appreciation. Gifts of a partner interest generally don't qualify for an annual gift tax exclusion, that $15,000 that you would think about that you can use for other types of gifts. If you're doing a sale with an IDGT, you will need to gift to the trust seed money because it has to be shown that there's economic substance to support the installment sale. So that's important. With an installment sale, you're going to have part gift, part sale. Also, you must use the applicable federal rate. And as I said, the interest is not reportable by the grantor, but it must be paid. We, of course, like to use an installment sale so that a trust can build up assets and pay the note over time if you aren't just using a straight gift. So let's look at a quick example of utilizing an FLP with a IDGT. And it's very simple. Mom and dad form a partnership and transfer securities, say, in exchange for a partnership interest. And again, they must have multiple business reasons for this formation, and that's where the tax professionals can help establish and document this. Dad forms an IDGT and mom can be trustee for the benefit of children. An appraisal is done. The certified appraiser said, based on the asset allocation, say there's a 30% discount. What has been benefited here? Well, instead of the value of that interest being $4.9 million, it's $3.4 million and change. The difference is $1.4 million and change. At 40%, senior member has saved $588,000 of estate tax plus future appreciation. In closing, before utilizing an FLP, work with your tax professionals to determine the income tax and the estate tax savings. So you're comparing the 40% estate tax rate versus the 23.8 tax on capital gains. This is particularly applies to marketable asset partnerships because in reality, FLPs have always been formed as a tax rate arbitrage where the client is accepting increased income tax at a later date, perhaps, in exchange for not paying as much, paying the higher estate tax. And the income tax may occur when you want to unwind or liquidate the partnership and you've taken discounts on valuing that partnership for gift or sale purposes. So it's the formation, the maintenance during the term of the partnership, and then the ultimate dismantling of the partnership that has to be carefully planned for. Now I'd like to introduce Michelle Ferrara, who will be speaking about Spousal Lifetime Access Trust.
Thank you, Marjorie. I'd like to welcome our attendees today, and I hope that you and your families are continuing to stay safe and healthy in these unprecedented times for all of us, especially as our communities start to reopen. With the United States still dealing with the coronavirus pandemic and the stock market volatility, it's really difficult to think about estate planning, but it may be a critical step to take now to preserve your wealth. While the decreased values in the stock market and closely held businesses are temporary, these challenges present unique opportunities for individuals who would be subject to federal or state estate taxes. With lower values, it'll allow for more assets to be moved out of your gross estate while using your available gift and estate tax exemption amounts. Depending on the outcome of the elections in November and any potential changes to the tax law prior to the sunset of the exemptions on December 31st, 2025, the opportunities in the current estate tax environment are about as favorable as it's ever been. So, what can you do today to accomplish your goals of utilizing your lifetime gift exemption before it's reduced, protect assets from creditors, and yet still have access? On our next slide, a flexible estate planning tool is the Spousal Lifetime Access Trust, which is commonly referred to as a SLAT. For married couples with the goals to reduce estate taxes and the protection of assets from creditors, it could help you to plan for the long term despite any changes to the transfer tax system, with that appreciation of the transferred assets sheltered from any future transfer taxes. A SLAT is an irrevocable trust. It's created by one spouse for the benefit of the other spouse. In addition, other family members, including children, grandchildren, and spouses as descendants, can also benefit as well. The beneficiary spouse is the current beneficiary of that SLAT during their lifetime. While the donor spouse gives up his or her right to the property transferred into the trust, the beneficiary spouse maintains access to that same property that they can share with you. This feature of indirect access provides flexibility by permitting a grantor spouse to make a gift while retaining some comfort that the trust assets can be accessed by the family if needed. A SLAT should be an effective asset protection tool as it can create a substantial barrier between the SLAT beneficiaries and their creditors, as the trust will contain a provision known as spendthrift, which will prevent beneficiaries from squandering their inheritance before they receive it, and it also protects beneficiaries' inheritance from creditors. A spendthrift provision in a trust prevents creditors of any beneficiary from touching assets as long as they remain in the trust. Keep in mind the SLAT's asset protection barrier is not bulletproof and that the creditor rights are governed by state law. Although the SLAT may not provide complete protection against all creditors in all circumstances, it remains an extremely effective asset protection tool in your estate planning. On this slide, we have listed some items for consideration in the planning for a SLAT. The SLAT is an irrevocable trust, and the grantor spouse may not retain any beneficial interest in the trust for the exclusion of the trust assets from their gross estate. In addition, the grantor spouse may not serve as trustee of the SLAT. However, the beneficiary spouse may serve during the lifetime of the grantor spouse with distributions to the beneficiary spouse made at the discretion of a non-spouse trustee, and distributions for support must not be allowed. At the passing of that grantor spouse, the beneficiary spouse may serve as the sole trustee with the distributions to her or himself restricted to an ascertainable standard such as health, education, support, and maintenance. The grantor, beneficiary spouse, current and future beneficiaries may have that power to remove or replace a trustee. The primary beneficiary of that SLAT will be the spouse of the grantor, with the children and grandchildren and more remote descendants as the remainder beneficiaries. In funding of a SLAT, it's imperative that it be funded with separate property that is only owned by the grantor spouse and not joint assets, to avoid the risk of the SLAT assets being included in the estate of the beneficiary spouse as a gift to the SLAT. In the next slide, the SLAT is flexible for married couples that want to utilize the current enhanced exemptions, but also need or desire to retain access to those gifted funds. In your planning for a SLAT, you'll need to prepare forecasts to support and determine the assets that will transfer to the SLAT. This means you should not transfer assets to the trust that you will likely need to support your lifestyle. The SLAT is generally treated as a grantor trust for income tax purposes, which means the grantor spouse reports the SLAT income on their personal tax return. This tax reporting of the income can enhance the effectiveness of the SLAT as an estate planning vehicle, as the SLAT can grow without the drain of income taxes, and more of the assets can benefit the next generation. The payment of the SLAT income tax by the grantor spouse is not considered to be an additional gift to the trust. Since we're in the midst of sudden economic downturn, many clients are focusing on asset protection and preservation. While the stock market and asset values will likely go up, clients can take this opportunity to leverage gifts now, reduce their taxable estate by transferring assets that are merely undervalued due to the temporary market conditions. In the next slide, the reciprocal trust doctrine should be addressed during the planning if you create a trust for your spouse and your spouse creates a trust for you. This doctrine suggests that if two trusts are too similar, which is not a clearly defined concept and based upon facts and circumstances of the situation, the Internal Revenue Service could uncross the trust so it would be treated as if you created a trust for yourself and your spouse created a trust for themselves. The Internal Revenue Service is successful, the intended planning would be defeated, as each spouse will be treated as having created a self-settled trust, which would be included in their respective estates for estate tax purposes upon death. Therefore, the more matters that can differentiate the trust and planning from each other, the better. During the SLAT planning, some considerations for the trust drafting to minimize this risk of the application of the reciprocal trust doctrine include the following: name different third-party trustees or co-trustees for each trust, different rights to access those trust assets, fund the trust with separate different assets, draft one trust to continue for multiple generations while the other trust assets will be distributed on a vesting schedule, or each trust could have different remainder beneficiaries. In my next slide, estate planning must be tailored to your unique circumstances and goals. For many people in these unsettling times, they do not want to lose the access to assets given away as they're not sure about their future needs. First, you should review your assets and financial forecasts to determine the assets to be transferred to the SLAT that will not be needed for your support. The grantor spouse will make the gift, the assets having a value up to his or her remaining gift exemption amount to the SLAT that he or she created. For some assets, such as stock in a closely held business, it'll require this business valuation report to determine the fair market value as of the date of the gift of the assets to the SLAT. With the business valuation, there may be discounts taken in the fair market value determination for lack of marketability and or minority interest or minority control to further leverage the value of the assets transferred out of your gross estate to the SLAT. The assets will then be titled in the name of the SLAT. Gifts made to a SLAT will be a taxable gift, and a federal gift tax return or a Form 709 will need to be filed with the Internal Revenue Service. With the allocation of generation skipping transfer tax exemption to the full value of the transfers to the SLAT, the assets will pass from generation to generation without the imposition of transfer tax. On the next slide, we have a pictorial here that is depicting non-reciprocal SLATs created by each spouse utilizing the 2020 lifetime gift exemption amount of $11,580,000. If one spouse does not own in his or her individual name sufficient assets to fully utilize his or her exemption amount, assets can be transferred between spouses as necessary to allow for the full utilization of both spouses' exemption through the creation of two SLATs. And the shifting of these assets between spouses should not be subject to transfer tax as a result of the unlimited marital deduction. With each spouse allocating generation skipping transfer tax exemption to the full value of their transfers to the respective SLAT, the assets will pass from generation to generation without the imposition of transfer tax. In order to increase the after-tax effectiveness on an asset transfer, it would be beneficial to transfer assets that have the potential to appreciate significantly outside of your gross estate. The assets that are not paid out to the beneficiary spouse will remain in trust and may continue to grow free of estate and gift taxes while remaining available for the next generation. On the next slide, we have depicted a sale to a SLAT. First, the husband will make a gift of seed money to the SLAT prior to the sale. And as Marjorie discussed, for the sale to the trust to be respected by the Internal Revenue Service, the trust must have assets that provide economic substance prior to that sale. And the general rule is the trust should have assets with at least 10% of the value of those that are being sold to it. That is, a rational seller in the real world would not sell assets to a buyer who does not own the 10% minimal amount to protect against downside risk of the sale. The husband, he will sell his asset at fair market value to the SLAT in exchange for a promissory note with an interest rate based upon the applicable federal rate in effect on the date of the transfer. For the determination of the fair market value of the asset, a business valuation may also be required, and discounts for lack of marketability and minority interest may apply. The promissory note could be provided to only have interest-only payments and a balloon payment due at the maturity. In May 2020, the applicable federal rate for a term of 3 to 9 years is only 5.8%, and the SLAT will pay the annual interest payments from the earnings on the SLAT asset. If the SLAT is a grantor trust for income tax purposes, the sale is disregarded and there is no gain recognized on the sale. In the next slide, we have summarized some of the key advantages and disadvantages of the SLAT for your consideration in your estate planning. For the advantages, the SLAT allows an individual to set up a trust for their spouse, sheltering those funds from creditors while allowing your spouse access to those assets which your spouse can share with you. All of the appreciation of the SLAT assets will be free of estate tax, which increases the amount that passes at your death, free of the 40% estate tax, plus any state estate tax. In addition, if the SLAT is a grantor trust, the SLAT income is reported on your personal tax return, which is essentially an ongoing gift tax-free transfer, as the SLAT assets will not be reduced with the annual payment of income tax. However, a SLAT might not be a good idea in difficult marital situations. SLATs can be effective tools in legacy planning for married couples that may generate unintended and adverse consequences upon a later legal separation or divorce. A divorce poses considerable risk to the functionality of a SLAT. With divorce, or if the beneficiary spouse predeceases, it would have the effect of cutting off the donor spouse's indirect access to the SLAT assets. There may be ways to mitigate this risk during the drafting of the SLAT for provisions for spousal rights in the event of the divorce. In addition, there is no step-up on the SLAT assets at the death of the grantor spouse if the SLAT is a grantor trust. Now, whatever the conclusion of the national elections in November and the possibility of new tax laws, the SLAT could be a valuable piece of your estate plan with the flexibility to adapt throughout one's lifetime while maximizing the gifting opportunities to benefit future generations. Now Ed Smith will be presenting our second polling question.
Thanks, Michelle. Let's go on to the polling question number 2 before we move on. Do you or do you represent clients that have an operating business that has been impacted by the COVID virus? Again, we'll have about 30 seconds for compiling answers. All right, that has been impacted, and as you can see, a number of impacts from COVID to the operating businesses. So we're going to now move on to Gary Duboff from our New York City office. Gary is going to discuss Grantor Retained Annuity Trusts. Gary?
Thank you, Ed, and thank you everyone for attending our webinar. It's great to be here today. As we all know, the pandemic has presented many challenges, but it's also provided us with a number of planning opportunities, as both Michelle and Marjorie pointed out. We can also assist our clients who currently have taxable estates pass wealth to loved ones in a gift tax-free, efficient way with a Grantor Retained Annuity Trust, also known as a GRAT. And over the next 15 minutes, I hope to share with you what a GRAT is, how they work, provide some realistic examples, and address some of the considerations in planning with GRAT. So on the next slide, we're going to talk about what is a GRAT. In its simplest terms, a GRAT is an irrevocable trust that is a grantor trust for income tax purposes. The grantor contributes cash or other assets to the trust. In return, receives an annuity for a fixed term of years. We're going to talk more about the term of years and the type of assets that they may want to contribute. The annuity doesn't need to be in cash, and the annuity can be paid in kind, which means that if you put in property such as stocks, bonds, and closely held business interests, as long as you can value those on an ongoing basis, you can make a distribution of the annuity using an appraisal of some type, or publicly traded securities. You can use the fair market value. And at the end of the term of years, the balance in the trust will be transferred to the beneficiary either outright or in further trust. Let's take a deeper dive on the next slide. More specifically, the grantor creates a trust for his children or his issue, and the trustee of this trust can also be the grantor to provide a little bit greater control from the grantor's perspective with regard to the investment alternatives. Excuse me. The term, as I mentioned before, can be variable. It can be a life, it could be a term of years, but it cannot be less than 2 years. In the next few slides, I'll give you some examples with different trust terms and share with you a couple of real life examples. The grantor can also transfer either cash, publicly traded securities, or privately owned business interests that have the potential to appreciate in value. Of course, once you contribute these assets, the expectation is that over time they will pass tax-free to your beneficiaries, the appreciation of the original gift over and above the original gift. So how is the gift actually calculated when you contribute? It's a little bit complicated, but I'll just state what it says here. The gift value is equal to the initial contribution plus a theoretical interest earned on the principal minus the retained annuity payments that would be made to the end of the term. Again, I'm going to share some examples in the next few slides. The theoretical interest rate that Ed has already mentioned before is the 75/20 rate. And the 75/20 rate is actually the federal midterm rate, 3 to 9 years at 120%. And the current rate, rounded up to the nearest tenth of 1%, is currently for the month of May, 0.8%. However, the IRS has already announced the June AFR for the 75/20 rate, and that June rate is expected to be 0.6%, which is historically the lowest rate that the 75/20 rate has ever been. On the next slide, I want to, before we get to the examples, I want to share why it's important and why a GRAT is such a wonderful tool and a great wealth transfer vehicle. First of all, it's very easy to create, and there's little cost to doing so. All you do is draft a document. Obviously, the document needs to be done by your attorney. We don't draft documents as CPAs. And you need to fund the trust with an appropriate asset, in which we would talk about what those assets might look like, but more importantly, you should focus on working with your investment advisors. And you'd have to file a gift tax return upon the inception and the funding of the trust within the first year. Other than that, there's very little cost involved. You may want to file a tax return, but it's not required. If you use your social security number for the actual trust, you don't have to file a tax return, but you may choose, or your accountant may choose, to prepare a tax return. Second, the upfront gift tax cost. There is a gift tax cost, but it can actually be reduced to zero, and I'm going to give you an example of what a zero-out GRAT is in the next couple of slides. The hurdle rate, which Ed has pointed out, is the 75/20 rate, and that is really the rate that we use to measure the success of the GRAT. To the extent the assets grow greater than this 0.8%, which is extremely low in even in today's environment, you will have a successful GRAT. There's very little downside because of the costs up front are so low, and that the interest rate is so low that for the most part, a GRAT will either be a win or a tie, but hardly ever a loss. So let's talk on the next slide about whether or not we want to use a short-term GRAT or a long-term GRAT. And what's the difference between a short-term GRAT? Now that you know what the GRAT is, it's best to share a few examples. So I decided that I was going to show a couple of examples, one with a relatively long-term GRAT of 10 years. Next slide, please. A relatively long-term GRAT of 10 years versus a short-term GRAT of 2 years. On the next slide, please, we're going to show you an example of a long-term GRAT. One slide back, please. One slide back, please. So let's take a good example. Let's say that Michelle owns Amazon stock, and she owns $1 million worth of highly appreciated Amazon stock, and she decides to contribute that stock to a 10-year GRAT for the benefit of her children. Michelle then decides to take an annual annuity of $100,000 over the 10-year period. Obviously, $1 million she's taking back from that $1 million contribution to the trust. In calculating the gift, the current gift, you take the present value of the stream of those 10 annuities, the 10 $100,000 annuities, using the current 75/20 rate of 0.8%, and the present value of that stream of payments is $957,370. So in order to determine the gift that was made upon the creation of the GRAT, the gift is the $1 million fair market value of the Amazon stock, less the stream of payments on a present value basis of $957. Hence, you have a $42,630 gift. So it's very simple. However, that gift won't qualify for an annual exclusion because it's not a present interest gift to your child. So what if I told you that Michelle could do the actual same transaction but have a zero taxable gift and not use any of her lifetime unified credit for this gift? So on the next slide, I'll share with you an example of what a zero-out GRAT is. Let's say Michelle does the exact same thing. She takes the Amazon stock, she contributes it to her GRAT for a 10-year period for her children, and her beneficiaries, or trust for the benefit of her children. But instead of taking a $100,000 annuity, she took an annuity of $104,453. This slight increase in the annuity will actually create a present value based on the 75/20 rate of $999,999. Consequently, the gift is really only $1. 1 million less than $999 equals $1. So you can see using a zero-out GRAT makes more sense because the incremental increase in the annuity payment is hardly enough to really change the ultimate results of the transaction and creating a zero gift on inception. So let's go to the next slide where you can actually see the numbers and put it all into context. And in order to do that, you need to factor in what does this Amazon stock look like, or what will it look like over the next 10 years. So I'm using a static approach here, but I'm taking an 8% growth rate in Amazon, and obviously that number could be significantly more or it could be less. It depends on your perspective. But if your beginning principal balance is $1 million and you take and you grow it 8% a year, it's worth $1,080,000 at the end of the first year. The anniversary date is when you take your first annuity, and you take a distribution of $104,453 at the end of year one. You have a $975,000 remaining balance, which will then continue to grow at 8% with an annuity each year over 10 years. And if you go right down to the bottom, the right-hand corner, you'll see what's left over at the end of the 10-year term is $645,000. What's important to note here is that if the overall interest rate or growth rate of the Amazon stock was greater than the 0.8%, which was the AFR at the time that it was formed, that this trust will have assets left over that will go to her beneficiaries. If, on the other hand, Amazon ends up being a big loser over a 10-year period, then ultimately there would be nothing left in this trust because the annuities would still be required to be paid, and consequently there would be nothing left over. That's what we call the failed GRAT, but the worst case scenario, as we pointed out before, is that this GRAT only cost you X dollars to create, and in order to and a gift tax return up front, and at the end of the day there was very little cost. So it's really a very simple transaction to put together and to its fruition at the very end. Let's go to the next slide. And we'll just kind of summarize what some of the advantages are that I just talked about. Why is a 10-year GRAT better than a 2-year GRAT? We haven't gotten to 2-year yet, but I'll just point out that the longer an asset grows, presumably, it means there's more potential for success over a long period of time. The second real advantage of a GRAT that both Marjorie and Michelle mentioned earlier is that much like a grantor trust, a defective grantor trust, a GRAT is a grantor trust. Therefore, the payment of income taxes that are generated by trust assets are taxable by the grantor on the grantor's tax return. And consequently, those payments of taxes are tax-free gifts to the beneficiaries, which leaves more assets to grow compounded in the GRAT. So you see all the taxes that were earned on Amazon, the dividends or other income that was reported by Amazon is not subject to tax at the trust level. It's taxed at the grantor level. On the next slide, we'll talk about some of the disadvantages of a GRAT. The primary disadvantage of a GRAT is that the GRAT assets will be pulled back into your estate if you don't outlive the term. So in order to have a successful GRAT, you need to live. So that's hard to predict whether or not you will or won't over a 10-year period, but 10 years is a long time. So a GRAT is not for the faint of heart. If you're not in good health, a 10-year GRAT may not make sense for you. Also note that there is no step up in basis in GRAT assets during its term. So it'll get pulled back into your estate and there won't be a step up in basis during the GRAT term. I mentioned before that it's a grantor trust, and because it's a grantor trust, there's a benefit of paying tax-free gifts when the income tax is paid by the grantor. That could also be a detriment. If, for example, the grantor doesn't have a lot of liquidity, or their other assets are depressed in a market due to the market or some other business failing or what have you, then there's potential that they'll be paying income taxes and they won't have the wherewithal to pay those. So that's one of the negatives of a GRAT. And generally speaking, while long-term growth is better than short-term growth, timing is really everything. And given the market and its unpredictability and the volatility of the market over the last few months, there's no guarantee that having a longer-term GRAT is going to be better than a short-term GRAT. Historically, we know long-term is better than short-term, but there's no guarantee. And last but not least, if you chose to rather than putting publicly traded securities into your GRAT, you chose an asset that needed to be valued, whether it was stock in a closely held business or some other type of asset that requires a valuation. In order to make the annuities each year, you need to have a valuation. It's extremely important to value those assets because any misvaluation could have a severe impact, a negative impact on the GRAT and the IRS's allowance of the GRAT as a statutory trust. So consequently, there could be a cost if you chose to do investments other than publicly traded securities. On the next slide, we're going to contrast the long-term GRAT with a short-term GRAT. And in this example, I'm going to say that Ed, our favorite speaker, contributes $1 million of Apple stock into his 2-year GRAT. And much like the GRAT that we showed before where we zeroed it out, we're doing a zero out GRAT for a 2-year. And in this case, in order to zero out this GRAT, Ed would need to take out $505,996 over a 2-year period over the first and second anniversary. The present value of those 2 streams of payments using the current AFR of 0.8 is again $999,000, and the gift is only $1. On the next slide, you'll see an example similar to the one I showed before, but over a 2-year period. The example is on the next slide, and you'll see that if you start with $1 million and it grows 8% in the first year, and you make your first annuity payment at the end of the first year, you have $574,000 remaining to be growing over the course of the second year of the GRAT. At the end of the second year of the GRAT, after the second distribution and a continued 8% growth, there would be $113,928 left in the GRAT. Seems pretty straightforward. You know, the AFR is 0.8%, so clearly an 8% return is going to provide you with a benefit. The nice thing about a short-term GRAT, you'll see on the next slide, is that one of the strategies that we like to implement, it's the last bullet on the page, is that we like to take the annuity that's paid after the first year and use that annuity to create a second GRAT. It's what we call regratting or rolling GRATs. And by doing that, it actually allows the investment that you're using, in this case, the Apple stock, to, you know, it increases your chances of success because there could be bad market timing. In 2 years, you don't know what the economy is going to look like and what Apple stock will look like. But if you continue to take that $500,000 annuity each year and put it back and create a new GRAT, you're more likely to be successful than if you just left it as is and only did one GRAT. Some other advantages, really, you know, this is the opportunity right now that we're in. The market took a very big hit over the last 2 months. Now, we've had a very big pullback in terms of the assets that have come back, but not all the segments of the market have come back equally. And there are still securities that in the market and industries that are really been severely impacted that over the next 2, 3, 4, 5 years could very well come back roaring. So this is really all about stock selection and finding the right investment asset to put into the GRAT. You know, in terms of dying during the 2-year term, there's obviously a less likelihood of dying over 2 years than over 10 years. So the short-term GRAT is more beneficial from that perspective. On the next page, there's some disadvantages of the short-term GRAT. They're all pretty much the same as the long-term GRAT, right? The long-term GRAT gets pulled back into your estate just like the short-term GRAT could. The long-term GRAT, there's no step-up in basis during the asset term, during the term of the trust, same as a short-term GRAT. And, you know, depending on your personal circumstances, the payment of the gift tax, the income tax of the trust itself on the trust assets could be beneficial, it could be detrimental. But I think the way I look at it is that the detriments of the short-term GRAT are essentially the same as the long-term, but there seems to be more advantages to the short-term GRAT. So making the short-term GRAT a slightly more favorable structure than the long-term GRAT. So a couple more slides and then we'll wrap up. What else do you need to know about the GRAT as you're executing and considering this strategy? First of all, once you put the money in the GRAT, other than the annuity, there are no loans allowed. So you can't really get the money back before the first anniversary or any money before any anniversary date. Valuations are going to be required if you're not using publicly traded securities. So there is an added cost to that. There is a provision that all GRATs should have in them called the substitution of assets. So it's really a beneficial strategy where a grantor can substitute assets of equal value. And if done properly, they can swap low basis assets that are in their GRAT for high basis assets that they own personally. And by swapping those assets in a grantor trust, you have effectively guaranteed a step up in basis in the grantor's hands if they were to pass during the term of the trust. On the last slide, there's three more considerations that I just wanted to point out as you're going through this analysis. And one is the generation skipping tax cannot be used during the term of a GRAT. It can be allocated at the end of the GRAT, which may not necessarily be the most effective use of your generation skipping tax exemption. And in terms of the premature death, sometimes we would, if a client is insurable, we would consider using term or other types of life insurance during the term of their trust in order to avoid or minimize the potential for the estate tax on a premature death. And last but not least, if you are married and you do have a premature death, you can structure your estate as such so that when the assets come back to your estate, they end up going to your spouse under the terms of your will or trust, therefore creating a marital deduction and not incurring a tax at the first death. That's all I have, Ed. Back to you.
Great, thanks, Gary. Before we move on to Charitable Lead Trust, we're going to do our polling question number 3, our last polling question. Which technique presented are you most interested in learning more about? SLATs, GRATs, entity sales to Defective Grantor Trust, Charitable Lead Trust, or none of the above? So GRATs seem to be the overall winner on that with 50%. That's great. Let's move to our last topic, and we'll try to go through it very quickly because I know everyone's going to want to get out to lunch. And that is, you know, for philanthropically inclined people, there's a vehicle called the Charitable Lead Trust that works well in this environment. Now, there are many, many variations of Charitable Lead Trust that you can play around with. But we're going to focus on the easiest to understand, and that is the Charitable Lead Annuity Trust, otherwise known as a CLAT. So if you go to the next frame there, thank you. Through a CLAT, a client can leverage their charitable contributions to shift wealth to family members in a tax-efficient manner. You probably heard more of the more common Charitable Remainder Trust, which is kind of the Charitable Lead Trust in reverse, where the charity gets the remainder interest after a person or persons receive an annuity for life. In the case of a CLAT, the charity would receive a fixed annual annuity payment through the term of the trust, and at the end of that term, the assets remaining in the CLAT would be distributed to one or more non-charitable beneficiaries, typically the grantor's children or other family members. The next slide, we'll talk about a couple of different types of CLATs, because they can only be a grantor CLAT or a non-grantor CLAT. As we learned earlier, you know, in a grantor trust, it means the grantor is the owner of the trust for income tax purposes. So grantor CLATs are drafted in such a way that all of the income and deductions are going to pass through the trust to the donor who's the owner of that trust. Now, what does that mean? That means that in the year of funding, the grantor can get a very large deduction, charitable deduction, because the present value of the income payments made to the charitable lead beneficiary over the term can be deducted in that first year. Now, there is a little bit of trade-off, and that is, as the owner of the trust, you get to deduct that big chunk in the first year, and you get carry forwards if you can't deduct it all. But they'll have to include the income and capital gains earned by that trust over the term. And if the grantor dies during the term, there could be some recapture of the income tax deduction. Going on to the next slide, we'll have the non-grantor CLAT. And the non-grantor CLAT is effectively a complex trust. All of the items of income and deduction are on a separate income tax return. The trust reports it. The trust gets the deduction for the annual annuity payment made to charity. So the income taxes should be minimized. So, you know, in choosing which one to do, you got to look at what your objectives may be. If you're looking for that big upfront discount or upfront deduction because you may have a sale of a business, or you might have won the lottery or something along that line, you're going to have a big income that year, that would be the reason to use the grantor CLAT. Now remember, the grantor CLAT, because it's a grantor trust, can only be funded at life, while the non-grantor CLAT can be funded either during life or at death. When it's funded, determines which 75/20 rate you're going to use. And as we've discussed many times with these interest rates, right now they are at the lowest in history. So where is the overall benefit going to occur? All right, and let's move forward just to the next screen here, where we can go through an example of how it works. All right, I've used someone named Bob, and Bob has a gross estate of approximately, liquid estate of approximately $20 million. Bob's divorced. Bob also has a love and affinity for his alma mater and wants to help them build a new building, which is going to cost, roughly $4 million. So he also has 2 children. He'd like to inherit the bulk of his assets. He understands, especially being that Bob is a relatively young guy, that estate taxes could significantly reduce the amount that ultimately passes to his kids. Bob has a pretty simple lifestyle, and because the bulk of his income is derived primarily that he spends from a portfolio of bonds, he generally has a relatively small income tax liability, and the remainder of his liquid estate is predominantly large cap stocks. As a result, his advisor advises him to fund a 20-year non-grantor CLAT with $5 million of growth stocks. The annuity payout to the school as the lead beneficiary is going to be $250,000 a year, or 5%, which over 20 years would be $5 million. At the end of the 20-year term, the remaining assets in the CLAT will pass to his children. That $250,000 annual payment certainly is going to help Bob's alma mater, but what happens on the transfer costs? Well, because the 20-year annuity payments to the school, because of those payments, the IRS discounts the value of the initial transfer at the time the trust is funded. The present value of the lead and remainder interests are calculated with the multiple factors discussed before. The assets used to fund the trust, the amount of the payout, the annuity payments, the trust term, and the 75/20 rate. The value of the remainder interest is a taxable gift to the CLAT remaindermen. All right. This is why the 75/20 rates are so important right now as far as the LEAP rates and what's going to happen when you look at these numbers. In this example, the present value of the school's annuity interest is basically slightly over $4.6 million. The remainder interest, which is the one subject to gift tax, is valued at $397,000, a little under $400,000. However, that figure doesn't really tell you what's going to go to Bob's kids in 20 years. Assuming the assets grow at 7% over a 20-year term, not unlikely for large cap stock, the remainder interest to pass to the children would be $9.1 million. And to give you an example, if it's 8% return, about $11.8 million would ultimately go to the kids. Because the trust assets appreciate at a rate higher than the 75/20 rate, he's going to transfer $9.1 million, albeit in 20 years, from his gross estate, with gift tax paid on the initial transfer of only $397,000. That's why SLATs in a low interest rate environment are particularly advantageous wealth transfer tool, especially for those that have a charitable desire. With that, we are finished. If you have any questions, please contact your MBAF partner or representative. We'll get you answers where we can. MBAF is here to support and assist you and your family during these very difficult times, and we're here to help you with all your tax and estate planning needs. So please feel free to give us a call. Numbers are on the sheet. Thank you very much.